Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome, everyone, to another episode of Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with the podcast, my guest and I will cover every angle of real estate under the sun, from interest rates to the economy to what's happening in Washington. Anything that affects our local real estate markets will be covered here. Obviously, I'm located in the D.C. metro market, as many of you know, but we will talk nationally. We'll talk about what's going on across the country. Much of what we talk about will be, as far as the good stuff, is going to be located in the bigger major metropolitan areas. Obviously, the national numbers tend to be distorted because of these major metropolitan areas are pretty hot, and you know, the reason why is there's more investment opportunities. I mean, it's somewhere between probably 35 and 45% of all transactions in the first quarter of 2014 were cash transactions. So that's not a normal, healthy market that we're in right now, but those major metropolitan areas, specifically D.C. and New York and San Francisco, are going to benefit from this low interest rate environment. More to the point, the rich are going to be able to capitalize on this low interest rate environment and be able to buy many, properties, either buy and hold or buy and flip. We're going to nail down today a couple things. We've often talked about with the Federal Reserve and the implications of keeping rates artificially low for an extended period of time, what that's, going to do. It obviously hasn't done much in 5 years. We've had a very low interest rate environment for some time yet, but many people have not been able to capitalize on these low interest rates to be able to purchase homes. And the reason why is it's quite obvious that the employment situation stinks. There's not jobs out there, and the jobs that are, out there are part-time work. So imagine trying to get 2 or 3 part-time jobs. That's not going to necessarily lend itself to being able to get yourself qualified for a home mortgage. On the flip side, we really don't have any wage growth as well, so it's not like people are making more money, but yet we still have home prices that are rising. Well, if wage growth is not keeping up with prices, at some point things have to go bust. And we were calling for some time that at some point that the Fannie Mae, Freddie Mac, Congress, the government is going to step in and start loosening guidelines again, because that's the only way that they're going to potentially be able to allow more people to buy homes at higher prices. Joining me on our panel, as he does each and every week, to discuss the issues at hand, is Louis Camerosano. Louis is a former school teacher, a former attorney, and a former general manager of a major real estate portal. He's been cited in the media as a real estate industry expert. He's been cited in the Boston Globe, Inman News, Wall Street Journal, Forbes, Smart Money, MSN, and numerous others. Louis, how you doing today?
I'm doing splendid, Ryan. How are you?
I'm doing well. Thanks for asking.
Excellent.
So, we've hit last week that Yellen had came out a week ago and said that, the world's biggest economy still pretty much needs a stimulus. Well, the world's biggest economy has been getting a stimulus for some time, some 5+ years now at this point, to really not see much traction at all by our measurements, at least. I mean, we're not really seeing, real job growth, real wage growth. We're not seeing the things that would definitely be indicators that the economy is moving in the right direction. We don't see, small businesses opening up all across the country and thriving. That's not what we see. We see high stock prices. We see rising home prices. But all that is basically just a mirage. It's the fact that we have artificially manipulated interest rates where the rich get richer, the poor get poorer, and the middle class is getting pushed down to that lower middle to poor. I said that in order for home sales to be able to potentially keep up with the rising demand that's going to take the rising supply, this spring and summer, was that lending guidelines were going to have to start to loosen. We were going to have to start letting people that probably otherwise wouldn't buy a home or probably can't qualify for a house to now let them back in. And I think they've made it the point that housing is one of the biggest components of our economy, and to let that stall out would essentially, I think, and what the FHFA finance director and everybody else is realizing is that if that goes and home prices were starting to slip back down, consumer sentiment, which last week was down, which I don't put too much stock in those anyway, but overall, the overall impression and sentiment across the country, I think, would be negative. What are your thoughts as far as what Fannie and Freddie has come out and say that they plan on loosening up their guidelines and kind of reevaluating the situation for all the regulations and everything that they just put forth. I mean, literally, they just put this forth. They just started getting implemented this year.
In fact, some of them are still in the proposal state, and they decided to abandon the proposals.
Right, they haven't even
because they were too stringent.
Absolutely, and so knowing that we have these artificially low interest rates where they're at, and most people can't take advantage of it. And I made this number up, but I almost feel like the eye test says that probably 2 out of every 3 people are getting denied for a loan. They feel it's now a necessity to loosen up these guidelines to now make it so where more people can now qualify, which you would assume would mean to have lower down payment loans, to have lower credit scores allowed. I mean, it's going to basically be allowing people that probably shouldn't buy homes or maybe otherwise couldn't buy homes, allow them to buy homes now. And ultimately it's putting us in the same situation as we were 5-6+ years ago where we were letting these people buy and obviously interest rates at that point in time, we had adjustable rates and all these sort of other products. But this is kind of where I see things headed all over again. And I want to get your take on it and where you think we're headed from here.
Okay, Ryan. So I disagree 100% that we've had this government policy and Fed policy directed towards pushing home prices higher. And now that they've reached unaffordability, they've got to come up with programs to help people overpay for prices that they've driven artificially higher through artificial manipulation of interest rates and the QE program, which, as you mentioned, has not improved the economy. It's only boosted home prices and stock prices. And in effect, QE has been nothing other than an ongoing bailout of the banks, or what I call bailonomics, for an extended period of time for 5 years. And now that they haven't got the economic growth that they claimed they were going to get last quarter, the first quarter, you had a 0.1% GDP growth. It's probably negative after they do the revisions. And they're saying that, well, housing is important. We can't let that go. So we're going to try to help people who can otherwise not qualify for a home to buy a home so they can overpay to keep this game going. It's crazy because what they need to do, Ryan, is allow the housing market to reach levels of affordability, which would increase the number of sales, which would increase the number of commissions for real estate agents, would get people moving in and out of houses, if that's what they think drives an economy, rather than having this low sale, low inventory, high price real estate market that we have. So they are destined to repeat the same mistakes that they just made recently. I mean, that old expression about those who don't learn the lessons of history are destined to repeat them is usually for people who are forgetting what happened 2 or 3 generations ago, not what happened last week or 2 or 3 years ago. Now, this is insanity. You have the same thing going on in the stock market. You have companies that make zero earnings that get boosted up just because it's a speculative environment and they keep going higher. And now you have home prices that have gone to levels where people can't afford them. So rather than letting the market adjust to that and realize the prices are too high, they come along and they say, no, they're not. We're going to help people buy them. And that's basically an entire manipulation of the market. It's not healthy for the economy. It's not healthy for the real estate market. But that's what they're going to do because if you read the quote from the guy who's now in charge of the regulator overseeing Freddie Mac and Fannie Mae, Mel Watt, he says, housing finance is such a critical part of the economy. To stop or stand in place is just not an option. And basically, they're saying is, we're going to do whatever we can because we just need higher home prices. We don't care if it's going to lead to a slew of bankruptcies, to unqualified people buying homes, to another catastrophe like we had last time. They need a housing recovery, and they're going to have one. And housing recovery to them means higher prices. That's all it means. It doesn't mean more qualified people who have jobs, who can afford homes, and are buying more and more affordable housing. No, it means higher and higher prices, and a few people being able to buy them, and now they want to get a few more people to overpay.
Yeah, I mean, it's unbelievable that the basic principles here of home ownership and what home ownership should be about. They don't care about any of that. It's really just to keep this, because I think that they, ultimately between the Fed, the Congress, the government, everybody, they all know that this is going to hit the fan. When it hits the fan, it's going to hit hard because they've let this underlying low interest rate environment continue for such an extended period of time that things have gone so far out of sight that they don't have any other bullets in the chamber, right? Like they
can only go one direction. They have to keep going in the direction. They have to keep heading towards the cliff and hit the accelerator because they cannot reverse course.
And that's why it's interesting that Yellen has now come back out and is saying that, it is important that our world's largest economy continues some sort of a stimulus here. And now we have Fannie and Freddie and the government now saying, that real estate is a critical component. So if they follow in lockstep, then one would assume that interest rates have to stay low, that Fannie and Freddie are going to implement programs that are going to help probably lower credit score, lower down payment folks be able to get into homes to keep, and not to mention that interest rates are going to need to stay at these levels, if not go lower than where they currently are, to be able to make this enticing enough for somebody, or just for them to be able to have the means to be able to take out a loan. Because as of right now, these people don't have large down payments saved up. Their credit scores are probably struggling at best for the majority of people. And to force those people into home ownership, only to probably see regardless of what interest rate they get, Lewis, whether it's 4%, 3%, 5%, or 6%, we're going to see the same thing happen all over again because the employment situation is not changing. So even if they get into their home and they're able to make payments for the first 5 or 6 months, what happens after that? You know what I mean? Then we have the same vicious cycle taking place where they now they can't make their payment. Now they're in a situation where they want to try to negotiate with the bank for a modification. Now they want to try to short sale or close. I mean, it's the same process.
It happens all over again, but from a point of weakness, because if you look at the data, we didn't have our call on Friday, but there was a slew of economic data, and what it pointed to was there was CPI and PPI came out, food and energy are higher, and of course housing is higher. Well, those are the hardest thing, the most important and the largest portion of people's budget. So if your housing costs are up, your energy costs are up, and your food costs are up, you're going to have trouble making ends meet and meeting that mortgage payment. Also, retail sales were down, wages were down. None of that is any good for a vibrant economy. And then we see as we see every week, the incessant cheerleading. Reuters, when the April PPI came out at 0.6%, which is the largest rise since September 2012, they put out a tweet, is anyone really concerned about inflation? And then they have another article out on the same day, retail sales slow, but growth outlook still upbeat. Why? It just the first sentence is, U.S. retail sales break sharply in April after strong gains in the prior 2 months, but that did little to change the views. The economy was poised for faster growth this summer. And then you have Bullard, one of the Fed presidents, saying that the job goals and our inflation targets are within sight. It's ludicrous to think that he's trying to cause inflation and that somehow he's going to be successful. But he's optimistic that everything's going to turn around. And you see that mantra across the board, Ryan, with the Fed saying everything's going to accelerate in the second quarter. Everything is fine, but yet none of the indicators are that anything is fine. And then you have lower interest rates, and now they're saying that the rates are lower because, well, maybe the economy isn't boosting up as much, and that's why the rates haven't gone up. But if you look at it, Ryan, they're stopping QE, which means they're taking the demand away of the $30, $40, $50 billion a month that they were buying in Treasuries without somebody replacing it. Well, if they can keep interest rates low without QE, why did they do QE in the first place? If they can just say interest rates are low. Now, we know that's not the case. The reason the interest rates are still low is because, as we've seen, and I can send you a chart from the U.S. Treasury on who's buying U.S. Treasury, Belgium has gone from holding $185 billion in U.S. Treasuries in March last year to $381 billion, all of which they bought in the last 3-4 months, which just happened to coincide with the Fed stopped buying U.S. Treasuries. So it seems to be a farce. Either the Fed is funneling money to Belgium so they can buy them, so they can keep the interest rates low, or Belgium's been told to buy them. Who knows? But the point is, you don't stop buying large amounts. You don't take the largest buyer, 70 to 80% of the newly issued Treasuries, which is the Fed, have them stop buying, and rates go down? No, they would go up because the demand for those bonds would go down, which would it makes absolutely no sense. But now they have lower interest rates, and they're going to claim they're going to keep lower interest rates, but they're going to play the facade that they're not involved anymore in the bond market. And the reason they're not involved is, well, rates are low anyway, and we're going to get this big boost in the economy.
Yeah. Well, Louis,
it's not going to happen, Ryan, but it is happening. That's what the incredible thing is. They've managed to keep the rates low, pretend that they're not printing money anymore, and that the economy is improving. And if it's not, well, there's a government program to get more people in homes. We'll just reduce lending standards so they can overpay for homes.
Absolutely. Back in 2003, 2004, I remember, and that was when, mortgage business was thriving, and, you used to look at these reports that come out, and I remember that one of the most important reports that you'd always pay attention to was the Fed meeting and whether the Fed was going to up the, prime rate or lower it, the Federal Reserve rate for banks. We don't really even care about that anymore, right? We don't care about that.
That's just a zero.
That's just at zero,
right.
and that's going to stay like that for some time. But we used to really pay attention to that because if they were going to raise that rate, that would mean that mortgage interest rates were going to get worse, and they were going to get much worse that day.
Yep. There was no QE back then. They weren't involved in the bond market in the same way.
Yeah, exactly. So, and we would hope. Okay, hopefully they're not going to raise the federal fund rate because that's going to make interest rates go higher. And then we kind of hold your breath and watch what they would do if they did.
But if they did and they only did a quarter point instead of a half point, you'd say, well, that's okay. The economy can absorb it. Rates won't go that high. It's a sign that the economy is improving. There was some logic behind how you can analyze what was going on.
Right.
It was a manipulation. It was. Ryan, you were still talking about the Fed was manipulating interest rates. But they were doing it just at that level. They weren't doing it by participating to 70, 80, 90% of the bond market buying treasuries.
Exactly. And so
mortgage-backed securities.
Right. Well, and you could actually advise clients that, okay, well, this is what was going to happen, and if this happens, then rates are going to do X, right?
Right.
Well,
pretty much.
Now, here we are, for the most part. I'd say 90% of the time you could guess correctly. Right. Now we are 10 years plus later. And we're no longer talking about the federal fund rate. We're now talking about QE. Okay, we're talking about QE and whether they're going to pull back or keep it the same or add to it. And
even now, that doesn't matter, Ryan, because we've seen that we thought everyone would think logically if they cut back on QE, rates would have to rise. And what they were saying at the time, if they did rise, it'd be okay because it meant the economy is improving and everything is fine. Well, we've seen they've cut back on QE and rates have dropped. So you can't make heads or tails of this. They've dropped. It makes absolutely no sense that they've stopped buying treasuries and rates have dropped.
Well, I think, and I think that we pretty much talked about this before, is that there is the backroom plan, right? The Fed has this plan that's in the background, which is, I think you pretty much hit the nail on the head. I feel like they're probably funneling money to Belgium, and they're probably going to be funneling money to many other countries to turn around and buy back our treasuries, buy back our mortgage-backed securities, so that it doesn't give the appearance that we're still buying our own stuff. We are. There's no
We're
way
going
around
to force other countries, our allies, who need our military protection, to either implicitly tell them or explicitly tell them, you got to buy X number of treasuries, and you're going to do it. And for ones that we don't have as much leverage over, we'll send money to do it for them.
Absolutely. And you can't go from buying 78% of the treasuries and mortgage-backed securities and dropping, almost on a monthly basis the amount that you're buying for interest rates to stay the same, if not go lower. It cannot happen. It's not.
No.
It's not possible for this to happen.
No, supply and demand. That's how it works.
And the fact that it is happening, it just tells you how far this manipulation goes. And it does not even matter. It doesn't matter whether the Fed is going to stimulate for $100 billion or $1 trillion or not at all, because they can literally create the market on their own, and it's happening, and it's been happening for some time now. If they really wanted to, Louis, they can make interest rates go to 2%, right? But
absolutely.
The problem with this is it doesn't matter because the banks are still on the other side, and no matter what interest rates are, it's proven that it's still very difficult for people to get home loans. Now, if Fannie and Freddie come back
Ryan,
out,
the reason they can't do this, we said, is not because they can't do it and they're not capable of doing it, and they will try to do it, is because the only way that'll stop is if external events prevent them from doing it. Like, for example, this week China is meeting with Russia, and they may come up with a non-dollar oil deal. That's the one thing they can't control, is if the demand for the dollar goes south. They can try to pump it up through their allies, but still, if the demand goes south, there's not much they can do about that. They can't. All they can do is force overconsumption of the dollar to a smaller number of countries that still use the dollar. And that's what they'll do. So if Belgium has a demand of $100 billion in treasuries, they'll pump it to $600 billion. If Japan has a demand for $200 billion, they'll pump that to $400 billion. That's all they can do. They cannot stop people from not using the dollar.
Well, and you know what's interesting,
and that will cause inflation, though, because the countries that don't accept the dollar, we're going to have to deal with, and our dollar will be devalued. And when we buy goods from China and Russia and other countries that don't accept the dollar, we're going to have to use more dollars to pay for them, and that will cause price inflation.
Yeah, and, many of these analysts have said that, okay, well, the reason why, interest rates have also stayed low is because of all what's taking place over there with Russia and Ukraine. And anytime there's global crisis going on, people have the flight to safety and place their money in bonds and things of those nature, which keep rates low. And I do agree with that to a point. However,
well, that would be the case also for gold and silver, and it isn't happening.
Exactly. And so we're actually not really, seeing that. And in light of, even if there wasn't what's going on with Russia and Ukraine, the Fed would still have interest rates where they're currently at. Because ultimately everybody knows, and you and I, Lewis, we talk about this all the time, this party, the only way that they can continue this is to keep low interest rates low, and then switch the mortgage platforms to where now we're going to allow people that wouldn't otherwise be able to buy to now let them buy. This is the only way that we can continue at this point, because even if they continue, if they created QE Infinity or whatever name they want to come up with a program to even force interest rates even lower, they still have to loosen the lending standards or come up with adjustable rate products or non-qualified mortgages, something that's going to allow for people that wouldn't be able to buy. That's the only way that the party can continue. And if they don't do that, we're going to continue to see new home starts. We're going to see existing home sales. We're going to see all these things really still fall off the cliff.
Which already have in the last year fallen off the cliff from the prior years. I think we're down 12% on new home and existing home sales. And home builder confidence came out last week also negative, under 50, with the 50 is it's okay, and anything below 50 means they're pessimistic. So retail sales, home sales, all of the demand drivers are down, but yet inflation is up. Wages are down. So if people make less money, prices are more expensive, and they're buying less, how is that going to – and 70% of the GDP is consumer spending? How are they going to get a positive GDP print going forward? Where's all this optimism for growth accelerating in the second and third quarters, other than they're going to have to try to generate it? They're going to have to pump more money in the system, give people money to go buy houses and everything else.
Right.
That's not how you run you shouldn't run an economy that way. You step aside and allow prices to find their own level where people can afford them.
Yeah, the only sense of optimism to me that they can really talk about is that the sun's coming out and it's not snowing anymore, right? Because what else is there? These numbers are not going to change. It's not going to be just all of a sudden things are going to get better. This week we have April existing and new home sales, which are going to be on Thursday and Friday. We also have the Fed officials are going to be speaking all week, Lewis, so it'll be interesting. I know you normally dissect on your blog when they start to speak and kind of give breakdowns of what they're going to talk about. It's going to be interesting to see now with what's going on with Fannie and Freddie, the language that starts to take place with these Fed officials, because it almost seems like they're going back towards that stimulus thing again, Lewis.
Yep.
They were
they've gained their credibility. They've pulled back for they've tapered, so to speak. Now it's unexpected, and the economy still needs just a little more boost. You go back to, Ryan, you go back to 2009. Ben Bernanke admitting he's printing money, QE had just started, but that when the economy began to recover, he would stop. When is it going to begin to recover? We've been through recovery summer in 2010, green shoots in 2009, accelerated in the second half in 2013. It's never happened.
Right.
They keep promising that what they're doing is working, and just a little more, just like an addict, just another taste. I just need a little more, and it's going to work. But what they do is they went clean and sober for the last 6 months to pretend to people that they're a responsible entity and they're not printing money like maniacs, and that the economy is actually working so we can achieve escape velocity, step back, and let the economy do its wonders. Nonsense. The economy has gone downhill even more since they supposedly pulled back, even though they probably haven't pulled back because they're still funneling money probably to Belgium to buy these treasuries. So where is it going to end? Right? Well, where is it going to lead? What excuses will they come up with in the second quarter, third quarter? Weather-related. You could have a terrorist event. That takes people's minds off of things. People talk about war or a terrorist event. That just basically removes, and it gives the Fed carte blanche to do whatever. After 9/11, the Fed just poured money in. No questions asked. After 2008 financial crisis, there were questions asked. The Congress voted against the stimulus. Then finally, a week later, they voted for it. But forget the stimulus. Congress doesn't even need to act. The Fed can act on its own and just pour money into the system.
Well, I told you that they've got to come up with at least 2 or 3 more good excuses because they got to get through Obama's term, which is going to be 2016. So they've got to, they might have a few more cards up their sleeves. But obviously, right now, they're still focusing on what's taking place in Russia and Ukraine, and so that'll buy them a little bit of time. I believe what they're going to have, they're scheduled to have an election over there. I believe it's this coming weekend. So there's still all this turmoil that's taking place over there. Investors are going to focus a lot of attention on that. And the interesting thing is when I just wrote down, you had talked earlier, the inflationary pressures are going to only increase, right? People's food bills, energy bills, health care, all these things. Just a basic family, if they just had, the basic cost of daycare, groceries, gas, health insurance, if you just go through those 4 things, Louis, how much of the budget's out the window already? You know what I mean?
The lower your income, it's close to 80-90%. If you take food, cost of heating your home, and the cost of your housing, there's very little money left over.
Yeah,
and if those prices are going up, beef prices are at an all-time high, so your food is ridiculously expensive. Your energy costs, especially if you have a cold winter with the polar vortex, or you have a hot summer, you're going to use more energy, and energy is more expensive. And if housing prices are rising and rents are rising along with them, that's massive inflation. And they try to tell you, who's worried about inflation?
Right, because they want to factor out food and energy, which are the biggest components, and what people spend the most of their money on.
They say because it's volatile. Yeah, it goes up and up and up. It just goes up a different amount each month.
Yeah,
it's not like 1 month, Ryan. Beef is at $3.29 a pound, and then it goes to $3.19, then it goes to $3.39, then it goes to $3.09. No, it goes from $2.89 to $2.99 to $3.09 to $3.19 to $3.29 to $3.49 it just keeps going up. It's volatile, but not either way. It's only one way up. And you have a drought, Ryan, now, and that's going to impact the summer growing in the fall prices too. Well, they'll say that's temporary, and of course that's to blame the weather, but still, prices are already heading higher for food.
Oh, most definitely. And we've already seen gas prices continue to rise up, and we're heading into the summer, so they naturally rise even higher when we get into the summer months.
Vacation travel, right?
Right, but the economy is moving in the right direction, so people should be able to handle that. I just don't think that's the case.
They had a lower initial jobless claim number, and as we've talked, that number is meaningless. It doesn't mean anyone got a job. It just means fewer people got fired from the week before, and we've had people getting fired now for 5 or 6 years in massive amounts. There's very few people left to fire. The employment market size is smaller, so of course there's fewer people getting laid off, but there's not more people getting hired, and not in the type of jobs that we need to grow the economy. And for people to have money to spend to pay these higher prices, wages are down, and to be able to buy homes.
Yep. Well, and we talked about Fannie and Freddie potentially loosening standards, and one of the big components, I think, and you touch on this all the time, is the millennials and the student loan debt that they have that's over their head, right? So one of the things that I thought about was that if they really wanted to be able to help those people that either don't have jobs or just took a job but still have huge debts over their head as far as their student loans are concerned, is they could put some sort of increased deferment on those student loans, right? Like defer them out, like another 4 to 5 years, to allow where they don't necessarily have to count against them if they were going to apply for a mortgage, where it's going to be deferred out. If it's deferred out for more than 3 years, they don't have to count it against them. These are the type of things that I think that they could loosen within the guidelines that would potentially make it feasible for these people to be able to buy houses.
So they can double down on their debt, even though if they defer the debt, they still owe the student loan debt. Now they can go out and get a mortgage and have even more debt. Or they can go one step further. They can cancel part of the debt.
Correct. Yeah. They could just forgive it. I mean, there's all sort of creative things, and see, that's where you figure the government's in control of Fannie and Freddie. I mean, obviously they're the ones that are lending out for student loans, so they're in control of that. They're in control
that's Sallie Mae. There's Freddie Mac, Fannie Mae for housing. Sallie Mae guarantees 100% of the student loans in the country. They're 100% in control. And if you think about it, in those two markets, the policies are designed towards getting everyone in a home and giving everyone education, and in the process, making them both massively unaffordable, other than if you can get a loan, which they'll guarantee and give you, so the price will continue to go higher. It's a scam.
Yeah, and even if they are able, let's just say they can get a small percentage of these buyers that are on the sideline right now to buy. Like, let's just say they can get
overpay.
An extra 10%. Overpay. And let's just say it's another 10 or 20% of the people. I don't think that that's even enough. It's not enough for what I see is the supply that's getting ready to hit the market this spring and summer. I don't think it's going to be enough, and I still think that the numbers are going. I mean, temporarily, I think that we would see a little bit of a spike, but I don't think for longer than a year or so that this is going to do much of anything, and it's just going to lead to even more of a disaster at the end of the road here. And I'm just running out of answers, Louis, honestly, because I just can't possibly think of what else that they could do other than just giving people a loan and telling them they don't need to be employed, right?
They're running out of basically. This is the point I'm making in a new blog post. Is once the government gets involved and the Fed gets involved so much in removing the price discovery mechanism and removing the ability of individuals to make money and make pricing decisions, they're basically in 100% control. The problem is when the government controls 100% of how much things cost, they have no idea how much things cost. And you have a massive problem with how the market works because, in effect, they become the market. You say it all the time, Ryan. The Fed is the market. But once that's the case is how much are bonds worth? What are interest rates worth? The market doesn't decide. The Fed tells you what they're worth. How much is an education degree? Well, 10 years ago it was $10,000 a year. Well, now it's $80,000 a year. It's whatever they can force it to be, and people don't get to choose because, especially when they make things like education, owning a home, health care, mandatory rights, well, then you have to pay any price you possibly can because you have to have them. They've told everyone they have to go to school. They've decided that everyone should own a home, and that everyone should have health care insurance. Well, if they're going to provide them, what difference does it make what the price is? To paraphrase Hillary Clinton, what difference does it make? You have to have it, so we're going to give it to you or make you buy it at this price. So you don't have any market dynamic saying, well, I'm going to pay less for this school, or I can't pay a 300% price increase in tuition. Sure you can. The government's going to guarantee it. I can't afford this health care insurance. Sure you can. You have to. It's mandated, so you have to buy it, and this is the price that it is. And if you don't like it, well, you're going to get a fine. Same thing with housing. I can't afford the housing. Well, we'll get you a loan.
Right.
And this is a real problem in the economy when you have the three major components. You have housing, education, and health care, all basically controlled by the government and the Fed, where basically prices are going to rise no matter what, and they're going to extract that money from you, but they'll help you. They'll help extract it from you by giving you a guaranteed loan that you have to pay back. And if you think about it, you have to pay back your student loan, right?
Yep.
And you have to buy health care insurance. So those prices go up no matter what, and you can't do anything about it.
Yeah, and what's interesting too is that Fannie and Freddie had kept mentioning that, or the government was saying that they would like to see some private participation in the mortgage market. Well, nobody wants to participate in the mortgage market when there's a low interest rate environment and uber regulation taking place, right? Right. Because it's a bad business to get into. But now all of a sudden, if you come back and you say Fannie and Freddie will continue to buy up all, be the basically the end all be all, they'll still buy everything, and now we're going to get rid of the regulation. Of course you're going to have private investors get back in. The only reason that they got out is because the returns weren't there, low interest rate environment, and there was too much regulation. Well, they're getting ready to relax that all over again.
Here's one, Ryan. We didn't mention in the things that they might do to reduce the requirements. You mentioned looser credit standards, abandoning a proposal that would require larger down payments, abandoning a proposal that would limit the size of mortgages that Freddie and Fannie would back. But there's another one, abandoning the current practice of requiring lenders to repurchase mortgages when the borrower misses 2 mortgage payments. So basically going to tell lenders, hey, don't worry about it. Yep. We're not going to kick anything back to you. We'll absorb it all. So go ahead, make loans that the borrower is going to miss payments in the first 2-3 months. Go ahead and make them anyway because we're not going to push them back to you. That's insanity.
And you know why they'd be in a position to do that? Because they've made billions of dollars now when they've been implementing these practices of regulation and being a little bit more, just overcautious on the underwriting standards or practices as to who gets a loan and who doesn't. So they made a lot of money, right? They probably have had a lot less defaults on mortgages because they've been super picky. Well, now all of a sudden they're saying, well, we got our piggy bank back, and guess what? Now we don't care. We're going to start taking these risks again.
Government is never supposed to make money, and they don't. And if they do, they don't return it back to the shareholders, the taxpayers. What do? They say, oh, we have money to waste. So let's make a lot of loans and lose money, so what, as long as Mel Watts says, the head of the regulator of the Freddie Mac and Fannie Mae, as long as we can get people into houses, because that's the most important thing. So what if we bankrupt Freddie and Fannie again? Doesn't matter. We've got the money now, so let's spend it. Let's waste it.
The craziest thing is I remember that literally a couple years ago, Louis. You remember how much of an uproar it was with the whole Dodd-Frank and all the bills that were going through as far as mortgage regulation, how everybody was up in arms, and all they cared about, Dodd-Frank, was essentially, making it so that this mortgage mess never happened again, right? And now how quick we've come in only 2 or 3 years. Now we're back on the other side of this, basically, where we don't really care about whether this happens again because that's what they're proposing they're to do all over again.
Right. That announcement went unremarked. It did not raise any furor because they've been telling us for 2 years, and people have become attached to the concept, there's a housing recovery, and everybody's got a vested interest saying, yeah, there's a housing recovery. And then they say, well, there's really not a housing recovery, and here's what we're going to do. It's like, oh, yeah, go ahead and do that. That'll work. Go ahead and lower the standards. We don't care about that. That was 2 or 3 years ago. Now we're into the housing recovery, and the housing recovery is slowing, so we can't let that happen. And everyone says, yeah, go ahead, do that. Unbelievable.
Yeah, it is unbelievable. I mean, we went from Greenspan and keeping the federal fund rate low for too long for years, and look what happened. Then we had Bernanke come in with the stimulus, and look what happened. Now we have Yellen with the same stimulus, and look like she's pulling it back, but she's really not pulling it back because somebody else is buying it, and I'm sure we're pressuring them to buy it. So where do we go from here? It's just going to be much of the same. It just might be disguised as something different, right? Because that's the only thing they can do. And then so they loosen up the lending standards. Then all of a sudden we get more people to buy, but they really can't afford their houses. So eventually at some point they're going to get taken back, and we're going to have to be dealt with who's going to buy these distressed assets all over again.
They never want to do it. What happened in 1979, 1980, 1981, starting with Jimmy Carter's appointment of Paul Volcker and under Reagan, where they made the courageous decision, if you're going to have a Federal Reserve, to raise interest rates, to break the back of inflation, to wipe out all of the distortions in the markets, and allow the economy to restructure, even though it meant a massive, the largest really depression that we had from 1979, 80, 81. They didn't call it a depression, but the largest recession we had since the Great Depression. But it was over in a couple of years. And that led to the growth in the early 80s. If you remember when Ronald Reagan was elected president, he had a horrible economy. Didn't look like he was going to get a second term because the first 2 years the economy was horrendous. And by 1984, when he was running in the summer, it was morning in America, Everything was starting to get on the uptick, and that boom lasted for a long time because the Fed actually did their job and took the painful medicine. But if you think about it, that got Jimmy Carter unelected, notwithstanding the hostage crisis and everything else, but he had a very bad economy, and he took the steps, or his Fed took the steps, to fix the economy. But it meant taking a lot of pain, short term. Instead, what we've done is, like you say, they don't want this recession to happen, to fall back into recession on Obama's term.
Right.
So they're not willing to make the courageous statements and say, we're going to cut spending, we're going to raise interest rates, but things are going to be better in a couple of years. That doesn't help Obama. It doesn't help his legacy. It doesn't help the elections in 2014. So they keep kicking the can down the road. And no one's had the political courage, and no one will, because you won't get reelected if you actually fight for policies that are going to eventually lead to a longer term, or at least a midterm, improvement in the economy.
Yeah,
everyone wants this stuff, and they want it now. Same with the housing, right?
Oh, absolutely.
You can't tell people you got to wait, you got to save. No, they need a house now.
Yeah, so you know what one of the questions, and for those of you that write in questions on realestate360live.com, on the right-hand side, that Ask a Question button, I know one of the questions we're going to get after this podcast is, Lewis, so, okay, I heard you guys talk about loosening mortgage underwriting guidelines and standards and things like that. So does that mean if I got turned down a couple months ago on my loan that I might not be able to qualify? I know that that's a question I'm going to get a lot now because after talking about it, and the answer to that is, well, it's not going to be just right this second, yes, but I will tell you in the coming months, maybe the next 3 to 6 months, that yes, you potentially might be able to, because I know that the first move that they're probably going to make is relax the credit scores. That's the first move. The second move will be the down payment, and they won't require as much. So, yeah, you might go from being denied a loan to approved a loan in probably the next 3 to 6 months. Now, I'm not saying for everybody, but I'm saying that it's going to increase the amount of people that are going to potentially be eligible. And remember, we're just talking about Fannie and Freddie here. We still have,
but that's 85% of the loans.
Well, but we still have FHA, which is a government-backed loan that nobody's really been using because there's a mortgage insurance component that's very expensive. Lewis, don't be surprised if all of a sudden FHA steps back in and they start changing their tune and they start lowering.
Yep. They're going to have to.
Yeah, they're going to lower their mortgage insurance premiums to become more competitive to allow
both government entities are not going to allow one to lose more money than the other.
Correct. Yeah. Well, and so that's what makes complete sense is that if
but they're going to get bonuses. You know, the people who come up with these, if they make more loans, even if they lose more money, the government people get bonuses.
We know
for implementing wonderful policies. You know.
Right.
You don't give them raises for denying loans and for becoming profitable. That doesn't fit with the policy of getting more people into houses.
No, and no, it's unfortunate because, as you said, I mean, the market that we really want is where interest rates are actually rising. If we had interest rates that were at 6% or so,
home prices falling.
Home prices are falling. Yeah, are falling back to levels where people would buy. And you know what? There's less people that are going to be in an equity position to be able to sell, but that's okay. It's not necessarily a bad thing for that to take place. But you know what? Nobody, as you mentioned, wants to go through that short-term potential pain for some people. But it's a necessity, and it was a necessity for us to go through this pain years and years ago. But the fact that we don't want to acknowledge it and that we just want to keep injecting, the drug of money printing. And
you've had a generation of people that are used to that. The stock market never goes down for too long. Housing, that was a miracle. They've created the image now that housing really doesn't go down. That was just an anomaly. Housing always goes up. And
it typically happens once we've convinced the masses that this is okay, right? That something bad happens, and it's like, okay, well, the stock market goes from, 16,000 down to 10,000 all of a sudden, and everybody's, well, what happened? What happened? Why did this happen? Well, it's been going on for how many years now? It was due for a pullback. I mean, it's so far, the stock market's so far gone at this point, Lewis, I just kind of laugh at it. And, I mean, obviously that you can make money in the stock market, and there's going to be people that say, well, see, you didn't buy when it was going up, and you said it was going to come back. And, of course, there's going to be those arguments, and I'm not arguing against any of it. I think that you can invest in the stock market and make money. But at some point, It's just like when we had the real estate market that was really hot and everybody was buying up a home or buying like a new home and reselling it without even moving in and making their money. At some point they got caught, Lewis, and they lost money, right? At some point they lost money, and it wasn't just a little bit of money; it was a lot of money. And it's gonna be the same thing in the stock market. And I don't care what anybody says; somebody's gonna get caught holding the bag. And unfortunately, it's going to be many of the everyday. Look
at research analyst reports that are going on and on about these internet companies about why they're justifying their valuations. There is no justification for a company that doesn't make money, has a market cap, I don't need to name names, of $4 billion.
Right. But they do these research and these reports to further try to brainwash and convince people of value that's not really there, right?
None. I mean, you cannot justify it other than you've accepted the concept that the valuation cannot be tied to earnings. It cannot be tied to dividends. It cannot be tied to anything other than there's growth ahead. Okay, you don't have to quantify it. Or they pretend to quantify it, or they make up numbers, and then people don't know any better and they believe it, and the analyst gets paid for writing such drivel, and everyone's happy because the price is going up. Right.
Yep. And as long as the prices continue to go up, then nobody bats an eye, right?
Nope.
I mean, that's pretty much.
It wasn't until after. Remember Henry Blodgett? He was one of the guys that was writing these research reports. I think he got in legal trouble over it. I think he was banned or something. And now he's back. He's on Yahoo. He has a program. People are listening to him. He's not a shill anymore. He's just, a respected commentator on the economy. When he was writing research reports that supposedly were paid for, by the underwriters. People say with Mary Meeker, if you remember this back in the internet period, companies wanted to get coverage by these hotshot analysts because it meant when they went public, they would achieve a ridiculous valuation.
Right.
And so it was more important not what the company was doing or its fundamentals, but what these analysts were going to say about it to make people forget about that and make them want to buy these shares and overpay for them and keep them. Then after the company would go public, 3 or 6 months later, they'd reinitiate or they'd put another strong buy on. They changed their coverage. And if you remember, there was never a sell. No one ever said sell. The worst they'd ever say was hold. And I was like, that meant sell. Everything else was buy, strong buy, buy with both hands. And that's how the stock market works.
Right.
It's not what the fundamentals are. It's who's boosting the stock.
Yeah, it's that's why I've almost I've convinced myself that it's in investing. Honestly, if you spent 99% of your time just following the Fed, paying attention to what they're doing and saying, and trying to stay one step ahead of them or just right there with them, then you'll guess right a lot of the time. And that's what the majority of people are doing. It's just the Fed has become so predictable because everybody, I think most people, especially Wall Street traders, have to know that they don't have anywhere else to go, right? They don't have any other solutions other than to maintain the same things that they've been doing for years now. And this is not likely to change. It's not likely to change before 2016. Just more of the same of finding something, creating another international conflict or war or something like that to divert attention, to spike some temporary stimulus of fundings of wars or whatever it may be. But those are the only things that could potentially pop up that are going to keep this thing going and divert attention away from what the Fed's doing and saying. Because it's a joke to honestly listen to them say the same thing over and over, Lewis. I mean, you and I have been talking about this for how many years now?
Yeah, but that works. If you repeat a lie often enough, people start to believe it, and even the people saying it start to believe it.
Yeah, I mean, we've never changed our tune in the fact that we've said that this is going to end badly, but the timing of when that's going to take place, we've been far off, and we didn't think that they would ever be able to continue on such a charade for such a long time. But they've been able to, to brainwash the masses and across the world, and who knows how long this could continue for. Now, on the flip side of this, there's always the opportunity for people that are out there that are still able to take advantage. I always mention this each and every show because it's true. People that do, but the unfortunate part is that it's going to be the 1% club for the most part that have the cash, that have access to funding and financing from banks to be able to go out and buy real estate, to be able to leverage portfolios to buy more stocks, buy more real estate, buy these things because they have the cash on hand to do that. And, you know, there may be a few people in that are in the middle that do have a growing business right now. And I still think that, yes, please, I tell them all the time, take advantage of the low interest rate environment because, you know, I don't really care where prices go, up or down. If you look at basic real estate investing principles and you're looking at what your rate of return would be if you're going to do a buy and hold or buy and flip, whatever it may be, but if you're specifically buy and holds, if you're locking yourself into interest rates somewhere in a 4% range, that is going to be a fantastic performing asset for you down the road because you don't have to worry about that, you know, that mortgage changing for 30 plus years. And if you could take out 10 or 20 of those guys, then you're going to be, you'd be sitting pretty. Like, I tell everybody, if you think that you're maybe in a position to do it, and go for it. There's, you know, but I just know that a lot of what has caused problems or issues is these underwriting standards for many of the people that considered buying a second home or an investment property is that they couldn't qualify for one reason or another, which just brought me another thing that I just thought about in my head. One of the guidelines, Lewis, that prevents a lot of people from buying another home is, let's say that they have a house that they own right now, but they're still upside down, but they want to go and buy another one. We talked about this where if they want to rent out their house and go buy another one because they have a down payment, but they can't qualify because they can't carry both mortgages. They can't qualify with the current mortgage against them plus the new mortgage. And the reason why is because that you must show in your tax returns 1 year of rental income on that rental property before you can count it and not have to count that full payment against them. Well, if they went back to the way they used to do it and they just required you to have a lease agreement for 12 months and you show the lease, they won't count the payment against you. That payment now disappears essentially. They take 75% or whatever it is of the payment, but that would become a wash, which that would be another way to lose.
There's no end to these tricks.
Yeah, and you see, that type of thing, though, isn't, you know, that's kind of behind the scenes and nobody would really pay attention. But those are the same things, the same practice that took place back when, because, you know, what happened right off the bat, Lewis, is people were manufacturing leases, right? They were creating leases for each and every property, and that's exactly where we're probably headed all over again because they have to come up with these type of things to be able to put people in the home.
Do you think, Ryan, though, in all this handing out money, that the self-employed entrepreneurs guidelines will be reduced at all? I didn't see any talk of that at all. It just seems that they're forgotten.
Well, if Fannie and Freddie comes out and they start loosening guidelines and it allows for private money to come back and potentially offer stated income loans for self-employed borrowers, which is not out of the realm of possibilities, then, I think they could help them too. As a matter of fact, I think that they're one of the first types of people that they should help. Because typically,
we should, but I don't think that I didn't read anything that's what they're planning, though.
Well, they don't have to come right out and say that. You know what I mean? But there's already stated programs out there. They're just not what they call them is asset depletion loans, right? Mm-hmm. Where they give you credit for income based upon your assets that you have, right? They'll deplete down your assets and give you a monthly income based upon the assets that you have, which is
I see. So if you have $400,000 and the house you want a $300,000 mortgage, they'll give it to you, even if you only have $50,000 in income.
Yep, they'll deplete down and give you credit for income there, even if you're not showing it on your tax returns. They'll base it off your assets. So
because you don't have the income. I see.
Yeah, exactly, and that's a form of a stated income loan. So what they do is they just call it something different. But I could see that them coming up with more creative ways, which is what they did back when, to be able to give self-employed borrowers, because I think that's the market that's really missing.
Right. They don't want people to have $400,000 in the bank because it's not being spent.
Correct.
So if you can get it into a mortgage, they'd like that, I suppose, right? If somebody has that kind of money, they don't want them just holding on to it.
They like them to have as much skin in the game as possible, and the reason why self-employed people have been hesitant because they didn't want to liquidate themselves, right? They didn't want to dump everything into the property, so they just didn't buy. But if they came back and they said, hey, there's now a 10% down product for self-employed people, right, where the only requirements is that you have to have over a 720 score and you have to have 12 months of reserves in the bank account. Will give you, a 10% down loan. I'm telling you, that's a game changer because there's a lot of people out there that are like that.
Would people go for a 10% when everybody else is paying 4 and 5?
I think they would because these self-employed borrowers are smart. They don't want to put up 30%. You know what I mean? They don't want to put up the 30 and 40%.
10%. I thought you meant rate. You meant put 10% down. Oh, sure. I thought you meant that they'd have to pay twice the going mortgage rate.
No, and I don't even think they would do that. I think that if it was, like, let's just say that rate was 4 for a standard mortgage, they might make it 5 or 5.5, something that's still reasonable.
Well, that would make sense, yes.
Yeah, and I think that that's definitely a possibility, but only time will tell. We'll keep our eye on it and see. And I'm on the forefront here, so I'll be looking at these guidelines, let people know what's happening. So if I can help somebody that should be getting a mortgage that can't get one, then that's at least somebody's going to benefit from this. Coming up on the end of the show here, Louis, I appreciate you coming on. If you give our listeners your website so they can check out your weekly blog, that'd be great.
Sure. Thanks, Ryan. It's smallgold.com, SMAULGLD, and we put up a blog post every couple of days on the economy, real estate, gold, silver, and we also put up all of the Real Estate 360 shows, and they're also available on the Small Gold YouTube channel. So please check it out. Thanks, everyone, and thanks, Ryan.
Thanks, Louis. Appreciate that. Guys, if you would I'd love to have you download, subscribe to our show on iTunes. Just search Real Estate 360 and download, subscribe, share to anybody that you may think would get some use out of this show. Also, if you'd like to ask a question, go to our site, realestate360live.com. And on the right-hand side, there's an Ask a Question button. And until next time, have a great week.